Imagine a legacy retail company, right? One that just boosted its profits by over 50% in a single quarter.
Which is a massive jump for any legacy brand.
Absolutely massive. But then, almost immediately, their own management team turns around and tells everyone to brace for a collision. It is honestly like you are riding in a sports car, going 90 miles an hour, passing everybody on the highway.
Right.
And right at the peak of the adrenaline rush, the driver just yanks the emergency brake and says, don't worry, we just need to be extremely cautious about the next mile.
It is total whiplash.
Exactly. That jarring, whiplash-inducing contradiction is basically the perfect summary of the Q2 2026 earnings report from Carter's Incorporated. Ticker symbol is CRI. Welcome to this deep dive. You and I are putting on our Talk Tickers hats today.
I am ready for it.
Our mission today is to act as your personal guides through this specific earnings call. We're going to take the dense Wall Street vernacular, the multi-million-dollar spreadsheet adjustments, and the macroeconomic forecasting, and distill all of it into actionable, plain language insights tailored specifically for you, the retail investor.
Because the paradox of this earnings call is really what makes it such a compelling case study. I mean, you have undeniable historical acceleration right there in the immediate rearview mirror. They absolutely shattered expectations for the second quarter.
Right, they really did.
Yet management used their time on the microphone to broadcast this level of forward-looking anxiety that I do not think the broader market has fully digested yet.
Yeah, they were spooked.
They really were. We are looking at a fascinating juxtaposition between past performance and future guidance. And the real story hidden beneath these numbers, it isn't simply about selling baby clothes. It is rooted in the rapidly shifting behavior of the American consumer, the bifurcation of wealth across different demographics, and some incredibly complex international trade mechanics currently sitting on the Carter's balance sheet.
Okay, so let's outline exactly how we are going to tackle this, just to respect your time and set expectations for the deep dive. First, we will hit the headline numbers, basically what actually happened.
Yeah, the raw data.
Second, the story behind those numbers, or why it happened. Third, management guidance, which tells us where we are going. And finally, the bottom line. Is this an overall bullish or bearish signal for you as an investor?
That sounds like a solid roadmap.
So let's set the table with the raw data before we dissect the narrative. On the surface, the top-line revenue number for Q2 was flashy. We were talking about net sales hitting $615.5 million. That translates to a 5.2% increase year over year. And crucially, I noticed this wasn't just one lucky division carrying the entire operation. They reported growth across all their major business segments. So that is U.S. wholesale, U.S. retail, and their international division.
And putting that 5.2% top-line growth into its proper macroeconomic context really reveals how significant it actually is. Because by mid-2026, the retail apparel sector has been facing massive headwinds.
Oh, completely.
I mean, we are seeing legacy retailers struggling just to maintain flat sales, let alone grow. The management team at Carter's explicitly noted that the children's apparel market as a whole only grew about 2% in the first half of the year.
Wait. Only 2%?
Yeah, just 2%. So clocking in at 5.2% indicates they aren't just riding a rising tide. They're actively taking market share away from their competitors. They are proving a level of resilience in the baby and kids segment that is genuinely difficult to execute in this kind of environment.
Well, yeah, because taking market share in a mature industry means someone else is definitively losing. So that covers the top line, the revenue flowing through the registers. Now, when we drop down to the bottom line, meaning the profitability, the numbers get almost surreal for a legacy brand.
They really do.
Adjusted operating income grew by a staggering 54% to $18.1 million. Their adjusted EPS, or earnings per share, jumped 53% to $0.26. That is up from just $0.17 a year ago. Seeing a mature apparel company generate a 50+% jump in operating income, that usually suggests a radical shift in their underlying business model.
It implies a massive unlock of efficiency. You rarely see those kinds of percentage leaps unless a company has fundamentally restructured how they operate or, they caught a once-in-a-decade tailwind.
Right, I hear that, but I have a major point of friction with these numbers.
Okay, let's hear it.
Because when I dug into the transcript, CFO Richard Westenberger proudly highlighted that 53% profit jump, but almost in the exact same breath, he admitted their adjusted gross margin actually dropped by 180 basis points, settling at 46.3%.
Yep. That is the paradox right there.
My initial instinct as an investor is that they are either aggressively cutting corners on product quality or they are engaged in some creative accounting. How do you shrink your profit margins but simultaneously grow your overall profits so drastically? The math just feels broken.
Well, the math holds up, but we definitely have to translate the underlying mechanics for the listener. Let's unpack the margin compression first. When Wall Street analysts talk about basis points, they are just using a really granular measurement for percentages. 100 basis points equals 1%.
Gotcha. So a drop of 180 basis points
Means their gross margin percentage fell by 1.8%. They went from keeping roughly 48.1% of every dollar as gross profit down to 46.3%.
So on a really granular level, every time they sell, say, a 3-pack of baby bodysuits, the raw profit they extract from that specific physical item is smaller this year than it was last year.
Exactly. Gross margin is strictly revenue minus the cost of goods sold. It excludes corporate overhead, marketing budgets, executive salaries, all of that. It is just the raw fundamental economics of manufacturing and selling the garment. And that specific margin shrank for 2 heavily weighted reasons.
Couture.
Well, management cited investments in product quality. They are enhancing the fabrics, improving the durability, which naturally raises the cost of production. But the truly massive anchor on that margin was a $28 million hit from incremental tariff costs.
Tariffs.
Right. Because of shifts in U.S. trade policy, the baseline tax required just to import their merchandise spiked. That $28 million expense eats directly into the gross margin before the product even hits a store shelf.
Okay, I can see how a $28 million supply chain tax compresses the gross margin. But that brings me back to my friction point. If the raw cost of the goods went up and the margin shrank by 1.8%, how on earth did they still deliver a 54% increase in operating profit?
The bridge between a shrinking gross margin and an exploding operating profit is built entirely on SG&A leverage.
SG&A, meaning selling, general, and administrative expenses.
Exactly. This category represents the cost of running the actual corporate machine. Store leases, distribution center operations, hourly wages, corporate headcount, and advertising. Carter's achieved nearly 300 basis points of SG&A leverage in this quarter alone.
Let me test an analogy on you to make sure we are locking down this concept for the listener. Imagine you run a neighborhood lemonade stand. Last summer, lemons were abundant and cheap, so your gross margin was phenomenal. Every cup you sold felt like pure profit.
Sounds like a good summer.
Right. But this summer, a bizarre import tax hits the lemon supply chain, which is our real-world tariff hit. Suddenly, lemons are far more expensive, your gross margin shrinks, and you are making less profit per individual cup. However, instead of hiring 3 neighborhood kids to help you run the stand and paying for a premium tent rental, you figure out how to run the entire operation yourself.
You cut the overhead.
Exactly. You use a cheaper folding table and you automate the pouring process. You violently slash your overhead costs. So even though your profit per cup is lower, your overhead is virtually non-existent and you manage to sell significantly more cups. At the end of the day, you count the cash in the cigar box and you have taken home a lot more money than last year.
The lemonade stand framework captures the dynamic perfectly. You are spreading your fixed corporate costs over a higher volume of sales while simultaneously shrinking those fixed costs.
It is brilliant.
The CFO explicitly detailed this in the call. Carter's actually faced inflationary pressures on store wages and physical rent, and they deliberately spent more on marketing. Yet they completely neutralized those increases through really aggressive productivity initiatives.
Like what?
They permanently closed their lowest performing retail locations, essentially trimming the dead weight. They modernized their distribution network. The 300 basis points they clawed back in corporate overhead completely overwhelmed the 180 basis point loss they suffered on the gross margin side.
Oh, wow.
The net result is that massive 54% spike in adjusted operating income.
The structural discipline there is just highly impressive. For the retail investor evaluating the headline numbers, the takeaway here is that Carter's operated a remarkably efficient financial machine in Q2. They absorbed a $28 million gut punch from import taxes, continued to invest in the quality of their garments, and through sheer operational ruthlessness, delivered a massive beat on earnings per share.
Right. Management proved they have a vice-like grip on the levers they can actually control. I mean, they cannot control international trade law, but they can control their store fleet efficiency and their headcount.
Okay, so we have established the raw data. They beat expectations. But cheering for the scoreboard isn't enough. We need to forensically examine the plays that scored the points. We have to figure out if the underlying drivers of this Q2 beat are sustainable, durable trends, or if they were just, one-off anomalies that are going to evaporate.
And digging into the specific divisions reveals a much more nuanced narrative. Let's start with U.S. wholesale. This is the division where Carter's sells immense volumes of product to major retail partners, like the big mass channel stores and national department chains.
Right.
U.S. wholesale net sales clocked in at $215.6 million. That represents an 11.7% increase year over year. In the current retail climate, an 11% jump in wholesale is absolutely staggering.
See, an 11.7% increase is the kind of number that usually sparks a massive rally. But reading through the CFO's commentary, he seemed almost defensive about it. He utilized a phrase that generally makes Wall Street analysts highly suspicious, and that phrase is pull forward demand. We need to clarify exactly how that mechanical shift works and why it dilutes the excitement of that 11.7% growth.
Yeah, pull forward demand is essentially the ultimate double-edged sword in inventory management. What transpired was that Carter's major mass channel wholesale partners evaluated their own supply chains, looked at the impending fall season, and made a strategic decision to secure their fall apparel inventory way earlier than they historically do.
Oh, I see.
So they placed their massive bulk orders and demanded delivery during Carter's second quarter, rather than waiting for the traditional delivery window in the third quarter.
The implication there being that Carter's didn't organically generate new unexpected sales. They merely shifted the timeline of sales they were already going to make anyway.
Exactly. They cannibalized their own future. It inflates the Q2 revenue, making it look like a blockbuster, but they effectively borrowed those sales from Q3. If you eat tomorrow's lunch today, you feel incredibly satisfied right now, but the hunger pangs are guaranteed to hit you later.
That is a great way to put it.
This wholesale pull forward is a foundational piece of evidence that explains why their future guidance takes such a dark turn later in the call.
That definitely makes the wholesale division look a bit like a mirage, or at least artificially amplified by timing mechanics. So if we pivot away from wholesale and examine their direct-to-consumer business, which is the U.S. retail segment, we get a cleaner look at actual consumer appetite.
Yes, much cleaner.
This segment encompasses their owned and operated physical Carter stores and their digital storefronts. Their retail comparable sales, or the comps, were up 5.1%. The transcript heavily emphasized that this marks the 5th consecutive quarter of positive comps.
Tracking comparable sales is vital for investors because it strips away the illusion of growth. If a company opens 50 new stores, their overall revenue will naturally go up, but that doesn't mean their core business is actually healthy.
Right, it just means they have more registers open.
Precisely. A positive 5.1% comp means that the exact same stores, open for at least 12 months, generated 5.1% more revenue than they did in the same quarter last year. Sustaining that for 5 consecutive quarters proves the underlying consumer demand for their direct retail offering is authentically expanding.
And the MVP of that direct-to-consumer growth wasn't even the brick-and-mortar fleet. It was their e-commerce operation. Chief Retail and Digital Officer Allison Peterson highlighted that e-commerce experienced double-digit growth, actually accelerating from the pace they set in the first quarter.
That gives them 4 consecutive quarters of digital growth.
But the detail that jumped off the page for me was the demographic shift. Peterson wasn't just talking about their traditional core customer buying essential basics online. She specifically called out a strategic pivot toward Gen Z families and multicultural markets.
They are aggressively hunting for a younger, highly engaged demographic of emerging parents. The transcript noted that Gen Z demographic growth on their platforms was in the mid-teens for the quarter.
Mid-teens is huge.
And they didn't achieve this by accident. It was driven by a highly calculated marketing initiative. They did a collaboration with the legacy sports brand Umbro, intentionally timed to intersect with the cultural momentum of the World Cup.
The execution of that strategy is fascinating because it shows a 160-year-old legacy brand operating with the agility of a modern streetwear label. I mean, they didn't just slap a soccer graphic on a standard toddler t-shirt. They hosted personalized jersey customization events in specific high-density World Cup markets. They integrated the campaign seamlessly across their digital app, their social channels, and their physical stores. Peterson stated it over-penetrated with Gen Z families. It was a cultural play that actually converted into hard revenue.
And the financial metric tied to that cultural play is what investors should really be paying attention to here. We need to introduce AUR, average unit retail. This is the simplest measure of pricing power. It is basically the average price a consumer pays for an individual item.
So if you sell 5 shirts for $50, your AUR is $10.
Exactly. Peterson emphasized that the Gen Z shoppers acquired through the Umbro collaboration aren't just browsing. They are actively gravitating toward higher-priced, higher AUR products.
They are demonstrating a willingness to pay a premium for fashion-forward, culturally relevant collaboration pieces rather than strictly hunting for clearance deals on basic white undershirts.
Right, and the Gen Z cohort they are capturing is proving to be incredibly lucrative. Not only are they accepting a higher AUR, but the data shows they are putting more total units into their digital shopping carts per transaction.
Okay, so they are increasing the basket size and the average price per item simultaneously.
Which means the marketing dollars spent on acquiring these specific younger families are yielding a high-quality, highly profitable revenue stream.
That is a phenomenal top-funnel acquisition strategy. But if we tie this back to our earlier discussion about slashing corporate overhead, the SG&A leverage, a massive influx of digital traffic usually requires a corresponding massive increase in customer service headcount to handle returns, sizing questions, shipping issues. How are they managing this digital surge without blowing up their payroll?
They are leveraging artificial intelligence in a way that goes far beyond a generic corporate buzzword. Peterson revealed that Carter's has deployed a sophisticated AI-powered consumer chat system. And this isn't a rudimentary FAQ bot that just links you to a policy page. This AI architecture is now successfully resolving 1/3 of all customer contacts.
Wait, 33% of all inbound customer service volume is being fully handled by software?
Yes.
The cost savings on call center minutes alone must be staggering.
The cost deflection is massive, but Peterson's framing of the strategy is what makes it brilliant. They aren't just hoarding the savings, they are reallocating their human capital. She explained that automating the low-level, high-volume tasks, like the standard, where is my order, or how many days do I have to return this inquiries?
The easy stuff.
Right. It frees up their actual human employees to provide premium care services. They are taking their best representatives and assigning them to high-touch, relationship-building interactions with their most valuable consumers, effectively turning customer service into a clienteling and retention tool.
It perfectly encapsulates the do more with less operational ethos that drove their Q2 beat. However, as impressive as the Gen Z marketing and the AI deployment are, we have to address the massive, undeniable financial windfall that fundamentally altered their balance sheet this quarter.
The tariff recovery.
Yeah.
It is a highly unusual liquidity event that completely changes the risk profile of the company in the near term.
The U.S. government effectively handed Carter's a check for $132 million. When you see an abrupt $132 million cash injection on a corporate balance sheet, you have to dissect the exact mechanics of how it got there.
Evaluating this requires stripping away any political context and strictly analyzing the mechanics of U.S. trade law. Carter's, like most apparel retailers, imports the vast majority of its inventory. Over the past several years, they have been entangled in a complex, industry-wide legal battle regarding the specific import taxes imposed on those goods.
Okay.
Historically, Carter's was required to pay elevated tariffs under a provision known as IEPA, the International Emergency Economic Powers Act. However, in February of 2026, a Supreme Court ruling essentially invalidated the specific application of those IEPA tariffs for certain categories of imported goods.
So the government had been actively collecting massive tax payments that the highest court later determined were not legally valid under that specific statute.
Precisely. Because Carter's had been dutifully paying those inflated, contested taxes for years, they were legally owed a massive refund. In Q2, the Treasury finally processed that refund. It comprised $128 million in gross profit recovery, essentially giving them back the money they overpaid on cost of goods sold, plus an additional $4 million in interest income, compensating them because the government held their capital for an extended period.
But to ensure total clarity for the retail investor listening to this is not entirely free money. It is a taxable event, correct?
It is fully taxable. The CFO disclosed that they recorded a tax provision of roughly $30 million related to this specific windfall, and that cash tax payment is scheduled to go out in September.
Okay.
But even after accounting for the tax hit, this refund was a monumental liquidity injection. Because of this single event, their total cash and equivalents balance at the end of the second quarter exploded to $653.6 million. If you look at their balance sheet from exactly 1 year ago, they only held $338.2 million in cash.
Wow, so they have essentially doubled their defensive war chest in 12 months.
Yes, doubled it.
Sitting on over $650 million in pure cash creates a fortress balance sheet. If you hold shares in this company, seeing that level of liquidity provides immense psychological comfort. particularly given the turbulent macro environment we are navigating right now in 2026. But liquidity is only as valuable as the executives deploying it. Carter's just installed a brand new captain to steer this cash-rich ship.
Sharon Price John. She took the helm as CEO and president, and at the exact moment she led this earnings call, she had only been in the role for 5 weeks.
5 weeks on the job. She is barely figuring out where the corporate cafeteria is, yet she stepped up to the mic and laid out a highly ambitious long-term vision for the company. I want to scrutinize her exact phrasing because it sounds radically different from how a traditional mall brand CEO talks.
Let's hear it.
She stated her primary objective is for Carter's to evolve into a consumer-centric and data-driven organization that explicitly focuses on maximizing customer lifetime value. She emphasized building an ecosystem that serves not just the child, but the caregiver and the gift giver.
It represents a profound philosophical shift in how the company views its own addressable market.
I have to play the role of the highly skeptical investor here, though. Is this not just the ultimate corporate buzzword soup?
It does sound like it.
Every Fortune 500 retail brand claims they're consumer-centric, data-driven, and focused on leveraging brand equity. I mean, an AI language model could generate that mission statement in 3 seconds. What is actually substantive or new about this approach for Carter's?
Your skepticism is entirely warranted. In fact, during the Q&A portion of the call, an institutional analyst pressed her on exactly that point, essentially asking how this vision materially differs from what they're already doing. Her response was one of the most revealing moments of the entire transcript.
Oh, really? What did she say?
She didn't shy away from the critique at all. She openly acknowledged that the terminology brand building data analytics sounds like standard corporate doctrine. She validated that the structural concepts aren't revolutionary on their own, but she insisted that, for Carter's, the magic is in the how.
The magic is in the how. That is a great soundbite, but what are the actual mechanics behind the how?
The how relies on weaponizing the infrastructure Carter's already possesses. They currently operate over 20,000 global points of distribution. They have immense multi-generational brand trust. What Sharon Price John is identifying is a massive failure to monetize the full life cycle of the consumer.
Okay, unpack that for me.
Historically, the timeline of a Carter's customer is highly transactional and time-bound. It begins when an expectant mother registers for newborn clothes, peaks during the toddler years, and essentially ends when the child sizes out of the brand around age 5 or 6.
Right, the relationship has a definitive expiration date.
Exactly. But her vision for maximizing customer lifetime value, or CLV, shatters that expiration date. She specifically spotlighted the gift giver segment. The mother who buys Carter's for her own child eventually transitions into an aunt or a grandmother.
Oh, that makes total sense.
If Carter's can leverage their AI chat, their enhanced digital app, and their massive pool of consumer purchase data to maintain a relationship with that specific human being, they can capture recurring revenue from her for 30 years, not just a brief 5-year window.
They are attempting to transition from a highly transactional model, where they simply sell you a cheap pack of onesies and hope you come back next month, to a deeply relational model, positioning themselves as a data-first platform for outfitting a family's generational growth.
Right. She wants the digital platform to anticipate a family's needs before the family even recognizes the need themselves, like sending a perfectly timed, personalized promotion for a size-up winter coat right as the data suggests the child is hitting a growth spurt. It is about maximizing the yield on every single acquired customer, which is fundamentally how a Silicon Valley software company operates, not a 160-year-old apparel manufacturer.
So if we synthesize everything we have discussed so far, the story driving this massive Q2 beat is a potent combination of factors. Wholesale partners aggressively pulling forward their inventory, a wildly successful marketing campaign capturing premium Gen Z digital traffic, sophisticated AI deployments slashing overhead costs, and a massive government tariff refund instantly doubling their cash reserves.
Yep, all of that.
All of which is being inherited by a new CEO intent on monetizing 30 years of consumer data.
Honestly, if the earnings transcript had abruptly concluded right there, the stock price would have likely rocketed upward in a straight, uninterrupted line.
But the call did not end there. The music stopped, and we have to slam on the emergency brake.
We are moving into the third phase of our analysis, which is management guidance. If the historical data of Q2 was so undeniably fantastic, we have to figure out why management suddenly became so defensive and pessimistic about the projections for Q3, Q4, and the full year 2026. The tone of the call shifted with alarming speed here. CFO Richard Westenberger took over to lay out the new reality, and he delivered a very sobering downgrade to their previous forecasts.
Let's put the exact revised numbers on the table so the retail investor knows exactly what kind of deceleration we're talking about. Previously, Carter's had confidently told Wall Street they expected full year 2026 net sales to grow in the low to mid-single digits. They have now revised that downward to a highly specific and much lower 2% to 3% growth rate.
Ouch.
More alarmingly, they announced that full-year adjusted EPS is expected to be down in the high single-digit to low double-digit range compared to last year. And looking at the immediate horizon, Q3 net sales are projected to be virtually flat at roughly $750 million.
It is a massive bucket of cold water. You just proudly reported a 53% jump in earnings per share for the current quarter. But in the next breath, you are warning the street that for the full year, your earnings are going to contract by nearly double digits. That is the whiplash we talked about at the beginning of the show.
The whiplash is intense. What are the specific culprits driving this downgrade? Because if I am holding this stock, I need to know exactly what is threatening my capital.
The CFO clearly outlined two primary culprits for the lowered expectations, and the first one ties directly back to a mechanic we already unpacked, which is conservative wholesale behavior. We have to revisit that pull-forward demand.
The mass channel big box stores pulling their fall inventory orders into Q2 instead of waiting for Q3.
Right. Because they pulled those orders forward, Carter's Q3 wholesale revenue is now projected to be down in the high single digits. But the CFO made it clear that the problem is far worse than a simple timing shift on a spreadsheet.
How so?
He explicitly noted that these massive wholesale partners have adopted a more conservative outlook on second-half inventory commitments.
Translating that into plain English, the big department stores and national retail chains are looking at the macroeconomic data, getting terrified about consumer spending, and actively deciding they refuse to hold a heavy inventory position going into the critical holiday season. They're ordering strictly on defense.
Exactly. Carter's is absorbing the collateral damage of their partners' macroeconomic anxiety. If a giant retailer like Target or Kohl's decides they need to carry 10% less inventory across their entire apparel department just to protect their own margins and avoid markdown risk, Carter's takes that volume hit directly on the chin in their wholesale division.
That makes sense.
They are entirely at the mercy of the open-to-buy budgets of these massive corporations.
That definitely explains the structural headwind in wholesale. But the second culprit the CFO identified is arguably much more concerning because it speaks to the foundational health of the broader American economy, and that is the value-conscious consumer.
This is where the macroeconomic reality collides with the retail operation.
Now, I want to challenge this point based on the transcript because I spotted what looks like a glaring internal contradiction in management's narrative.
Let's unpack that.
During the retail segment of the call, Allison Peterson emphatically stated that their e-commerce channel is booming. Gen Z is flocking to the digital app, and they are enthusiastically buying higher-priced premium Umbro items. They are putting more high-EOR items into their carts.
Right.
But fast forward 20 minutes to the guidance section, and the CFO is blaming a value-conscious consumer who is displaying heavy price resistance. How can both of those realities coexist? Are consumers freely spending on premium cultural drops, or are they aggressively penny-pinching?
It is an incredibly astute observation, and it highlights the exact bifurcation of the economy we are currently living through in 2026. The contradiction is real, but both statements are entirely factual. They just apply to two radically different segments of the Carter's customer base.
Reconcile the two segments for me. How does a single brand manage both?
Okay, so the e-commerce channel, fueled by highly targeted social media marketing and cultural collaborations, is capturing a very specific demographic profile. These buyers are generally younger, potentially have slightly higher discretionary income, and are highly motivated by fashion trends and exclusivity.
The Gen Z shoppers.
Exactly. That specific consumer cohort remains resilient and willing to spend. However, Carter's is a ubiquitous, multi-channel behemoth. The overwhelming majority of their sheer volume still relies on the everyday, middle America mass market consumer shopping in strip malls. And the data shows that that specific consumer is getting absolutely crushed under the weight of the current economy.
The transcript was incredibly blunt about the macro factors. The CFO specifically cited sustained higher gas prices and persistent inflation across many important consumer purchase categories.
Gas prices function as an unavoidable tax on the working class. If you are a middle-income family and your weekly grocery bill has surged by 15% and it now costs you $75 to fill up the tank of your minivan just to get to work, your pool of discretionary income basically evaporates.
Right. There's just nothing left over.
You simply have less capital available to spend on premium baby clothes. The CFO used a highly technical phrase to describe the fallout, noting a distinct loss of unit velocity.
Let's define loss of unit velocity for the listener so they know exactly what the CFO is seeing in the data.
It simply means that when that everyday mass market consumer walks into a physical Carter store, their behavior has fundamentally changed. Instead of impulsively buying 5 items, they are strictly buying the 3 essential items they desperately need. The actual speed at which physical units of clothing are moving off the shelves and through the registers has measurably slowed down.
Okay.
The basket sizes are shrinking. Carter's attempted to hold on to some of the strategic price increases they implemented earlier in the year, but they quickly realized the consumer was balking. They hit a hard ceiling of price resistance.
And because the consumer refused to accept the higher prices, Carter's was forced to pivot. The transcript noted they had to engage in higher than expected clearance activity, meaning they had to aggressively discount their seasonal goods just to flush them out of the system before they became dead inventory.
The leaky bucket analogy applies perfectly here. You have this fantastic high-margin stream of revenue flowing in from the Gen Z e-commerce buyer, but your main bucket, which is the massive volume of the mass market, has a leak because inflation is aggressively draining their wallets.
Yeah.
To maintain your sales volume and prevent inventory from piling up, you are forced to slash prices, which severely damages your profitability.
And looking forward, management is explicitly projecting that this extreme price sensitivity is going to persist throughout the entire second half of the year. He lowered their revenue guidance because they are modeling a scenario where they have to be highly promotional, running constant sales, offering deep discounts just to coax cash out of the consumer during the hyper-competitive holiday season.
And the timeline for testing this theory is incredibly compressed. They issued a very specific warning about the month of September.
The September make or break. Management emphasized that September is historically one of the highest volume months for their entire business cycle. It essentially dictates the success or failure of the third quarter because it encompasses the critical back-to-school rush and the transition into early fall weather apparel.
If you are an investor holding this stock, your entire near-term thesis hinges on September. You are essentially holding your breath, waiting to see if the core consumer actually shows up to buy fall jackets, or if they decide their kid can wear last year's coat for a few more months.
But the consumer anxiety isn't the only dark cloud hovering over this guidance. We have to address the other massive structural headwind, which is the tariffs. We spent a lot of time celebrating the $132 million refund they received for old tariffs. But a refund on past taxes does not mean the current trade war is over.
No. It is far from over, and this is where international trade policy reaches directly into the retail investor's brokerage account. The CFO outlined a highly complex transition in the tariff structure.
How so?
Well, the old Section 122 tariffs, which imposed an incremental 10% tax above the baseline on imported goods, expired literally days before this earnings call took place.
So they got a brief reprieve from the 10% tax.
The reprieve lasted seconds. The expired Section 122 tariffs were immediately replaced by new Section 301 tariffs. And crucially, these new tariffs are more punitive. They range from 10% to 12.5% above the baseline cost.
So the tax burden actually increased. But this raises a major accounting question. If these new, more expensive tariffs went into effect in Q3, why aren't they guiding for a massive immediate collapse in their Q3 gross margin?
The delay in the margin impact is due to the fundamental accounting mechanics of physical inventory. It revolves around a concept called capitalizing into inventory. When Carter's imports a massive shipment of fleece sweaters in August and pays that new 12.5% Section 301 tariff at the port, that tax penalty does not immediately hit their profit and loss statement.
Oh, really?
Right. The cost of that tariff is capitalized. It sits on the balance sheet as part of the total assigned value of that specific inventory.
So it is essentially locked inside the sweater on the balance sheet.
Precisely. It only bleeds out of the balance sheet and onto the P&L as cost of goods sold at the exact moment that specific sweater is finally purchased by a consumer, which might not happen until November.
It acts like a financial time bomb, sitting quietly on the balance sheet, just waiting to detonate their margins months down the line.
Changes in tariff rates rarely have an immediate recognizable impact on earnings. The true pain of these elevated Section 301 tariffs won't be fully realized in the financials until late Q4 or potentially bleeding into early 2027 as those specific heavily taxed goods finally flow through the retail system. And beyond the tariffs, there's one final non-operational headwind dragging down their earnings guidance.
The debt refinancing issue. The CFO noted a specific $1.30 per share headwind that has absolutely nothing to do with selling clothes or managing inventory. It is entirely driven by higher interest costs.
We are operating in a significantly higher interest rate environment globally compared to a few years ago. Carter's refinanced a portion of their corporate debt last year. Because rates are higher, the sheer cost of servicing their own debt, meaning making the interest payments, is materially more expensive now.
Yeah, that makes sense.
That extra interest expense acts like an anchor on their net income, mechanically dragging down their earnings per share by 30 cents, regardless of how flawlessly they execute their retail strategy.
The guidance section is essentially a gauntlet of macroeconomic challenges. The whiplash we felt at the beginning is now fully explained. They delivered a spectacular Q2 driven by wholesale timing shifts and a massive one-time tariff refund. But they are staring down at Q3 and Q4, where their massive wholesale partners are terrified of holding inventory, the core middle-class consumer is financially exhausted, new and higher tariffs are creeping onto the balance sheet, and their own corporate debt is more expensive to maintain.
It requires an incredibly skilled management team to navigate that level of concurrent risk.
Which brings us to our final act. We are moving into the bottom line. This is where we deliver on the core promise of the Talk Tickers format. We have analyzed the raw data, we have unpacked the complex story driving the beat, and we have stared into the murky crystal ball of management's lowered guidance. Now I have to weigh the scales. What does this actually mean for the retail investor who is holding CRI in their portfolio or considering initiating a position today?
The most effective way to synthesize this is to construct the strongest possible bear case and the strongest possible bull case, relying strictly on the data and the transcript we just dissected.
I will take the bear case. If I am an institutional short seller, or if I am an analyst preparing to slap a sell rating on this stock, my thesis essentially writes itself based on the guidance. The core American consumer, the engine of Carter's volume, is tapped out. Inflation and sustained high gas prices have drained their discretionary income, leading to a demonstrable, data-backed loss of unit velocity. Carter's management has already confessed they hit a wall of price resistance and were forced to rely on higher-than-expected clearance activity in Q2 just to move seasonal goods. That promotional pressure is guaranteed to intensify in the hyper-competitive Q4 holiday season, further eroding margins. Furthermore, their wholesale partners are openly nervous and actively scaling back inventory commitments, which chokes off a major revenue stream. You layer on the $1.30 EPS headwind from interest costs and the looming specter of the 12.5% Section 301 tariffs slowly poisoning the balance sheet, and you are looking at a company whose profit margins are under siege from every conceivable angle. Why on earth would I allocate capital to this stock when their own management is projecting earnings to decline by double digits for the full year?
That is a formidable, highly rational bear case. But as the resident bull for this exercise, I can construct an equally compelling, data-driven counter-argument that suggests the market is deeply mispricing the asset.
Let's hear the bull case. Why am I buying Carter's into the teeth of a macro downturn?
You are buying Carter's because of extreme liquidity, undeniable market share gains, and aggressive digital modernization. First, you have to look at the balance sheet as a shield. This is a legacy retailer sitting on a fortress of over $650 million in pure cash. They generated over $200 million in operating cash flow in just the first half of the year.
That is a lot of cash.
In a volatile, highly uncertain macroeconomic environment, cash is absolute king. That $132 million tariff refund was a monumental de-risking event. It insulates them from disaster and provides the ammunition to aggressively invest in marketing and tech while their competitors are starving for capital.
Okay, I see that.
Second, despite all the macro headwinds you mentioned, they are actively taking market share in the baby and kids segments. In a flat 2% market, they grew 5.2%. They aren't just surviving the storm, they are structurally outperforming their peers. Third, they are empirically proving they can acquire the next generation of parents. The sustained Gen Z e-commerce growth, driven by culturally relevant high AUR marketing like the Umbro drop, proves this brand is not a dying mall relic. And finally, despite the required clearance activity, management is still confidently projecting gross margin expansion in Q3 of nearly 200 basis points, simply because they are lapping last year's severe tariff hits. If you believe the macroeconomic cycle will eventually turn, that inflation will cool and the consumer will normalize by 2027, Carter's is perfectly positioned as a highly efficient, cash-rich market leader ready to capture disproportionate gains on the rebound.
The scales are definitely heavily loaded on both sides. So what is our final verdict? What is the definitive, actionable takeaway for the retail investor listening right now?
Synthesizing the tension between the fortress balance sheet and the struggling consumer, the verdict is that Carter's is fundamentally a wait and see on the consumer store. It is a remarkably resilient legacy brand that is successfully modernizing its tech stack, driving incredible SG&A leverage, and hoarding cash. However, in the near term, the stock is going to trade as a highly sensitive proxy for broader macroeconomic data. If the monthly national inflation reports come in hot, or if gas prices spike, Carter's stock will likely suffer, because algorithmic trading models know their core mass market consumer is highly vulnerable to those specific inputs.
So the stock isn't necessarily trading on the inherent quality of their baby clothes or their AI chat. It is trading as a real-time barometer for the financial health of the working-class American wallet.
But for the patient, long-term investor, that near-term downside volatility is heavily anchored by their exceptional liquidity. A company holding $650 million in the bank, generating strong cash flow, and demonstrating a ruthless grip on their SG&A expenses is not going bankrupt anytime soon. The downside risk is capped by the cash.
I think that is the most balanced, intellectually honest read on the situation. The downside is protected, but the upside requires macroeconomic cooperation. But before we wrap this up, I want to leave you, the listener, with one final, highly provocative thought to mull over. Something that builds on everything we just discussed, but forces you to look at the stock from a completely different angle.
Lay the thesis on us.
We've spent the last hour meticulously analyzing Carter's through the traditional lens of an apparel retailer. We debated margins on physical garments, tariff impacts on shipping containers, and wholesale inventory metrics at department stores. But if you look closely at the DNA changes Sharon Price John is initiating inside the company, the narrative shifts.
It definitely shifts.
Their AI chat architecture is now seamlessly resolving a third of all customer contacts, driving massive SG&A leverage. Their digital app engagement with the highly coveted Gen Z demographic is soaring, accompanied by higher AURs. The new CEO is openly pivoting the entire corporate strategy toward maximizing customer lifetime value through predictive data, attempting to capture the child, the caregiver, and the gift giver in a closed-loop 30-year digital ecosystem.
When you string those specific data points together, it sounds significantly more like a Silicon Valley software pitch than a pitch for a traditional mall brand.
Exactly. So here's the question you have to ask yourself as an investor, evaluating the long-term potential of CRI. Is it possible that the market is fundamentally misclassifying this company? If Carter's can successfully transition from being a purely transactional clothing manufacturer into a tech-enabled, data-first consumer platform for growing families, will Wall Street eventually be forced to reevaluate how they value the entire enterprise?
That is the million-dollar question.
We know that tech platforms and recurring revenue data models command wildly higher valuation multiples than traditional mall retailers. If they can actually crack the code on monetizing 30 years of family data, the current stock price, weighed down by near-term macro fears, might look like the bargain of a lifetime in hindsight.
It is an incredibly compelling thesis to monitor. If they can utilize the AI and the data pool to drive durable, recurring revenue across multiple generations of a family, the multiple expansion on the stock would be immense, but it hinges entirely on execution.
It is the ultimate execution story. And it brings us right back to our original metaphor. You are sitting in that sports car. The engine is roaring with technological efficiency and a massive influx of cash. But the driver has one hand gripping the emergency brake, terrified of the macroeconomic potholes in the immediate road ahead. Do you trust the driver to navigate the potholes? And do you believe the car is actually evolving into something much faster? That is the decision you have to make with your capital. Thank you so much for joining us on this deep dive. We hope this Talk Tickers breakdown provided you with the clarity, the context, and the actionable insights you need to intelligently navigate the market. Keep analyzing the data, keep questioning the consensus narrative, and we will catch you on the next one.